So welcome to this course, Corporate Finance Fundamentals. We are so excited to share this course material with you. So in this course, we will cover all the foundational aspects of corporate finance. We're going to break the course into 3 logical sections. The first section, we're going to cover capital investment. Section 2, we're going to look at capital financing. And finally, for section 3, we'll look at capital return. By going through these 3 sections of the course, we'll understand exactly how corporations think about all aspects of capital allocation. When we look at capital investment, we'll understand exactly how corporations select the best projects to invest in to make sure that they're creating value for the shareholders. For capital financing, we'll look exactly at how the corporation selects the appropriate mix of debt and equity to finance any investments, resulting in an optimal capital structure. And finally, for capital return, we'll look at the different ways that corporations can return capital to shareholders if they don't have appropriate projects to invest in. So we'll definitely cover the theories and concepts, but more importantly, we're going to apply all of those theories to practical situations. We have plenty of Excel examples lined up for you to complete to make sure that you know exactly how to apply all of the academic concepts that we're going to touch on. So we can't wait to share this material with you. Let's jump in and get started right away. So let's quickly discuss the learning objectives for this course. First of all, we want to make sure that we understand exactly what capital investment is and why it increases a company's assets. Secondly, we want to learn the common metrics that companies use in order to evaluate various investments. We also need to understand the business life cycle and how that lines up and impacts the funding life cycle of an organization. When we talk about capital financing, we need to understand the different types and sources of equity and debt that are available to companies. Then what we're going to do is we're going to utilize the right mix of debt and equity in order to minimize the company's weighted average cost of capital, or WACC. And finally, for situations where the company cannot find adequate investments or has excess capital available, we're going to look at the advantages and disadvantages of the various ways that a company can return capital to shareholders. Now, the ultimate goal of corporate finance, or its purpose, is always to maximize the value of a business. And this is done through planning and implementing management resources and always balancing risk and profitability. Now, we mentioned that this course would be divided into 3 sections. For the first section, when we talk about capital investment, we will look at deciding what projects or businesses to invest in. We're always looking to earn the highest possible risk-adjusted return. In the second section of the course, we'll look at capital financing, and this is where we'll determine exactly how to fund the capital investments that we've selected. We're always looking to optimize the firm's capital structure, and this is done by minimizing the weighted average cost of capital, or WACC. And finally, in the third section of the course, we'll look at capital return. And capital return is what a company would do when there are no adequate businesses or projects to invest in. We'll decide how and when we want to return capital to investors. One of the things to keep in mind is that there are 6 basic types of transactions that a company can engage in. The first type would be an initial public offering, or an IPO. This is when the company issues equity in the form of shares to the public for the first time. After an IPO, or initial public offering, the company could do a follow-on offering. This would be when the company wants to issue more equity to public shareholders. Now, while a follow-on offering would be open and available to any public shareholders, the company may choose to do a private placement, where it would be issuing shares only to a select group of shareholders. Now, the first three types of transactions involve the company seeking forms of financing, but we could also look at mergers and acquisitions, or M&A, and this is where the company would look for other companies to possibly invest in. Another form of financing which could be available to the company is a leveraged buyout, and this is where a private equity firm may be interested in taking a position or completely acquiring the company. And finally, the company may look at divestiture. So the company may put itself up for sale and look for possible companies which would be interested in purchasing it.
Continue learning. Join CFI today.